Yeah, yeah. Um, there's two different values for your house. There's the assessed value and the market value. The market value is the amount that the house can sell for. So what people are willing to pay for it. It is based on the features of the house. How many bedrooms and bathrooms does it have? Is it one story, two story? Does it have a porch? Does it have a deck? Does it have an attic? Does it have basement? Garage, all that stuff, as well as the land that it's on, the square footage of the house, the location of the house. You guys have heard that, like with business, location, location, location. Same thing with property. You can have the most fabulously beautiful house on the planet, and if it's in a bad neighborhood, it's not going to be worth a whole lot. Um, Property taxes are annual taxes that you have to pay if you own property. They are paid to the state and local government, and they are based on the assessed value of the house, not the market value. So the property taxes don't fluctuate with the real estate market. It's the interest or the percent can change yearly to yearly, but the assessed value of your house pretty much doesn't fluctuate hardly ever. The assessed value is the value placed on your home due to the features and the land. So it's not the location, um, it's not the economy. They look at the square footage of the house. They look at, does the house have a single story or two stories? Does the house have a basement? Does the house have an attached garage? Does the house have a swimming pool, a tennis court, things like that. Um, Property taxes are also, and your assessed value, both, are only based on permanent structures. Okay? So these are structures that are on a foundation or built into the land. And the property value taxes are also based on your assessed value is based on like the acreage of your land. But let's say you have a house, a small house, and you also have a detached garage that's sort of like a converted shed that's not on a foundation. It can be moved, like if you took it apart. That garage won't count towards your assessed value because it's not a permanent structure. If you own land and you put a mobile home on it, it does not add or count towards the value of your land. It's permanent structures. Does that make sense? Okay. Your down payment, you can get a no down payment mortgage if you have excellent credit. Sometimes. But for the most part, they expect you to put a percentage of the house. You have to have that cash up front. And then you finance the remainder. That percentage can range between 5 and 20% of the purchase price, depending on various factors to do with your own personal credit history and things like that. But probably no less than 5% ever, and probably no more than 20%. Of course, if you had more than 20% and you wanted to put it down, that would just lower the amount of money you'd have to take out on a loan, which would save you a lot of money in the long run. But I don't think they would really ever require more than 20%. If you think about it, on a $100,000 house, 20% is you have to have $20,000 cash. So, your mortgage is just a loan, but it's a loan for houses and property versus just a car loan or something like that. Mortgage is specifically for houses and property. There are different kinds of mortgages. There's a fixed rate and an adjustable rate. A fixed rate mortgage, you guys will hear that, fixed rate mortgage. A fixed rate mortgage means that during the life of the mortgage, so the 20, 30 years that you have the loan, the interest rate cannot change unless you refinance, which is a different loan altogether. But on that actual loan, the original loan, the interest rate cannot change. It stays the same for the whole time. An adjustable rate mortgage they will put in the paperwork the terms for how often they will adjust the rate. It can be annually, it can be every 2 years, it could be every 5 years. It'll be in the paperwork. And that interest rate will adjust to align with the economy and the current interest rates at the time, which are dictated by the Fed. Are you guys familiar with that? The Fed? Have you heard that term before, the Fed? The Fed? On the news, like the Fed looking at interest rates, blah, blah, blah. That's the Federal Reserve Bank. Yeah, and it's called the Fed. It's the Federal Reserve Bank, and the Federal Reserve Bank dictates allowable interest rates. And they do it to stabilize and boost the economy. And if you take an economics class, you'll learn a whole bunch about all that. But the Fed dictates the allowable interest rates. And so if you have an adjustable rate mortgage, if the interest rates go down, that's good for you because your mortgage interest rate will go down, which means you pay less money. However, if the interest rates go up, that's bad for you because that means your interest rate on your mortgage will go up and your house payment will increase. So adjustable rate mortgages are a gamble. You're gambling that the interest rates are going to go down during the time that you're trying to pay off your house versus going up, but you're talking about a 30-year interval. It is impossible to predict the economy over an interval for that long. So it's gambling. Okay. Foreclosure is when the bank takes back your house because of non-payment of a mortgage. They sell it to someone else. Now, here's the tricky thing. Some people, when their house is being foreclosed on, they do what's called stripping the house. Have you guys ever heard of that? They take out the appliances, they take out the cabinet work, they take out anything that's worth any money at all and sell it. Yeah. Or they get mad and they just like completely damage the house. What they don't think about is that when you are foreclosed on, and this is the same thing if you have a car that's repossessed, the bank takes the thing that they repossessed from you, the house, and they sell it on auction. If you owed them $130,000 and the house sells on auction for $130,000, you're good. If you owed them $130,000 and the house sells on auction for $30,000, you still owe them $100,000, even though you no longer have the house. When people do that stripping the house or damaging the house because they're being foreclosed on, they're making it less valuable, which means they're going to continue to owe the bank tons of money. So, just in case that ever happens to you, which it won't, but just in case it does, don't shoot yourself in the foot. It's bad enough if you're getting a foreclosure. You don't want to make it a foreclosure that will continue to ruin the rest of your life. And a lot of people do that because they get mad and they don't think. But it'll never happen to you guys. You guys will be fine. Homeowners insurance. You are required to carry homeowners insurance if you have a mortgage. The bank or lender will require it, and that's because until you pay off your house, you don't actually own it. I mean, it's your house, but you don't own it. The bank owns it. Okay? So the bank requires you to have homeowners insurance because they want to make sure that, for example, a hurricane comes through and tears apart the house, that you have the money to cover it because they want their money. If the hurricane comes through and or a tornado, let's say a tornado comes through and it levels your house completely, it's gone. And then the bank, your next mortgage payment is due and you don't have homeowners insurance and the bank says, you owe us your mortgage payment, and you're going to go, for what? The kindling on the ground? I don't think so, right? So that's why they require homeowners insurance, so that if the worst case scenario happens and the house is destroyed, they'll still get their money, because what happens is the homeowners insurance gives the money to the bank first because they actually own the house, and then you get what's left over. Okay, for something like a complete catastrophic loss like that. But if you have some storm damage, for example, the hurricane came through and it rips off part of your roof, homeowners insurance will pay for the roof to be repaired. If somebody comes into your house and steals your stuff, homeowners insurance will replace your things. So will renters insurance, by the way. Highly recommend it. If your apartment complex catches on fire, renters insurance will replace all your stuff. Nice to have. Now, floods. In Florida and in other areas, floods are not covered under homeowners insurance. You have to have separate flood insurance. And in some insurance policies, things like hurricanes are not covered, so you have to pay for separate hurricane insurance. And so when you buy your homeowners insurance, find out what is and is not covered so that you can supplement with supplemental flood or hurricane insurance as necessary, because you don't want to think you're covered and then a flood happens and you're not, and then you get nothing because it was a flood and you don't have flood coverage. Okay, so be really careful. It's like those. Okay. Monthly payment formula. This is the formula used to calculate the monthly payment. For those of you that were here first semester, does this look familiar? Or first term? Kind of, okay. All right, P. This is the amount of the loan. R, let's do a different color. Let's do purple. All three R's. This is your interest rate as a decimal. Don't forget that. And T and this T, both of those T's are the length in years. It has to be years. Heather's buying a house. She has some money for a down payment already. Good for Heather. She sees a house she'd like to buy and computes that she would need to borrow $190,000 for a 30-year period. So mortgages typically are 15, 20, 25, or 30 years. You can get shorter mortgages for smaller amounts. You can't really go more than 30 years, though. I've never heard of a 40-year mortgage. 30s is like the max. Okay, so we've got 30 years, that's T. 190,000, that's P. That interest should have a T on it. And here's R. But we have to convert it. So we move the decimal 2 places. 1, 2. Okay. Monthly payment formula. So now we just plug everything. R is 100, or P is 190,000. R is 0.064 divided by 12. T is 30. And repeat. Okay. 12 times 30 is 360, so I'm just going to put that in here. Okay, so that's the first thing I need to do, is calculate my exponent. The next thing I need to do is figure out what this 0.064 divided by 12 is. .064 divided by 12 is .005 with a repeating 3. Up to the 360. Okay, so now I'm going to add 1 to that, and that makes it 1.005 with a repeating 3. So I do this part first. I have to raise that to the exponent. So I raise that to the power of 360. And that gives me 6.786247 ... And that's the same number as I'm going to have down here. With a -1 after it. Okay. Then I multiply all 3 of these numbers across the top. So I'm going to multiply that times .005 with repeating 3's times 190,000. And my numerator is going to be 6876.73. And then my denominator is going to be -1, so 5.786247. So my monthly mortgage payment is $1188.46. Okay, the question I have to answer though, what will be her total interest for the 30 years? Okay. This 360 up here is not only, oh, I didn't mean to put that, is not only the exponent, this is also the total number of payments that you'd have to make. So to calculate her total interest, I'm going to take her monthly payment and multiply it by 360 because that's how many payments she's going to make. And she's going to be paying $427,845.60 for the house. From there, I'm going to subtract the $190,000 she actually borrowed. And I will get $237,845.60 in interest. So we're talking about assessed value. They want to figure out their property taxes. Here's this house, and this is the way that particular county or town calculates property tax. Okay, so they have a 2-story colonial. All right, so here's a first floor versus you have a basement versus a slab. That's a foundation, concrete foundation. And then you have your second floor, and it's based off of per square foot. You have a garage per square foot, a dormer. And a dormer is, you know, when you see like on the side of the house, like here's that roof of the house, and then they have some windows that like stick out and have little roofs on them. And sometimes it's like a big stick out thing that has a little roof on it. That's a dormer. So they can be small or they can be big. Barn, deck, sheds, or vinyl lined pools per square foot. And then flat rates, land is $1,000 per acre. You don't get any money for having one bathroom because that's pretty much a requirement. Having a full bathroom that's extra, you get $100 each, or half bathrooms get you $50 each. Fireplace, tennis court, spa, central heat, and central air and gas heat. This is what you get for those. So we have a 2-story colonial with 2.5 bath, fireplace, full basement, central air conditioning, a 30 by 30 foot deck, 3/4 of acres. The first floor is 600 square feet. First floor is 600 square feet. There's a basement, so we're going to use this one. So we have 600 times $3. The second floor is 1,500 square feet, and you might think, well, that's weird. How is the second floor bigger than the first floor? Well, there's a garage. Where did it say that? Right here, garage. So part of the second floor goes over the garage, which is pretty common, actually. Okay. We have 2.5 bathrooms, so the first bathroom got us nothing. The second one gets us $100, and the half a bath gets us $50. Okay. We have central air conditioning, so that gives us $200. A 30 by 30 foot deck. Well, decks are 50 cents a square foot. So we're going to take 30 by 30 by 50 cents. We're on 3/4 of an acre. Land is $1,000 per acre, so we get 3/4 of one of those. We already did the first floor and the second floor. We have a 20 by 20 foot dormer. Dormers get us $1 a square foot. We have a 12 by 21 foot garage. And garages get us $1 a square foot. We have a 16 by 32 foot vinyl pool. Pools get us 75 cents a square foot. We have gas heat, that gets us $700, and it's in excellent condition. That doesn't get us anything. So now we're going to multiply all of these out. So $1,800 for the first floor. Let's see, 1,500 times 225, so that's $33.75 for the second floor. $100 for the second bath. $50 for the half bath. $200 for the air conditioning. It's a 900 square foot deck, so we're going to get $450 for our deck. We're going to get $750 for our acreage. $400 for our dormer. $252 for our garage. $384 for our pool, and $700 for our heater. And then we have to add all that up. Now, this may not be accurate to where anybody lives or anything like that. I don't know, honestly, the exact amounts even in this area for things. So this is just the process. We're not necessarily. Yeah, this will give us the assessed value, which is what you pay your property taxes based on. Which is $8,461. Okay. I don't think that was supposed to be 0.89%. I think that was supposed to be 89%. I could look really quick, actually. Yeah, it was supposed to be 89%, not 0.89%. Okay. So this is how they assess the value. The assessed value of the house is $8,461. We take that 8,461, we multiply it by 0.89 for our 89%, and we get their property taxes are $7,530.29 in this per year. Here we have, this is what's called escrow. Okay, escrow is what happens when you pay your mortgage, insurance, and property tax in one bill. And what happens is homeowners insurance and property tax are usually both annual. Well, property tax for sure is annual, and most homeowners insurance is annual. So you only pay those once a year. So what the banks will do is they'll create what's called an escrow account. And they take your property tax, your annual property tax amount, they estimate it, and they take your homeowners insurance amount, and then they split it by 12. They tack it onto your mortgage, so you pay a little bit more than your mortgage every month, and then they hold the rest of it, the leftover, into an account, and then when the property tax and the homeowners insurance are due, they pay them out of that account, out of the escrow account. Does that make sense? So you're like prepaying it. Okay. So what happens is if your mortgage is $1,233.56, and that's monthly, your annual property tax they divide that by 12. And that gives you your monthly property tax. And then they take your annual insurance bill and also divide it by 12, and that gives you your monthly. Okay, so first we're going to divide each of these by 12. Okay. So then what you pay to the bank every month is the mortgage, the monthly property tax portion, and the monthly homeowners insurance portion. Now, the beauty of an escrow account is that, let's say property taxes are due in January or something. You don't have to come up with $5,000 extra in January, and you don't have to worry about budgeting for it throughout the year. It's already budgeted for you, and it's being held in an account. And then it's taken care of for you. That's the nice thing about escrow. And you don't have to worry about penalties and things because you couldn't pay. Credit decisions, whether or not you get a loan, are based mostly on your credit score, which we talked about when we talked about the credit chapter, but that's not the only thing they're based on. They're also based on what's called your front end ratio and your back end ratio. Okay, your front end ratio is your monthly housing expenses divided by your monthly gross income. Okay, and by monthly housing expenses, what I mean is your mortgage, your property tax, and your homeowner's insurance. Okay, this is just the money that you're paying every month for the actual house, not any of your other bills, not any of your other debts. Okay, so this is like the cost of the house only. So what we do is we take our monthly mortgage payment, we have annual property taxes and annual homeowner's insurance, and then we also right here have an annual salary. So we have to figure out make all these monthly. They all have to be monthly. So so our monthly income, we're going to take 135,511 and divide it by 12. Oh, it must be nice. $11,292.58 a month. Yeah, that's what I just said. Must be nice, right? Okay, monthly mortgage. So we'll have our monthly housing now. So that's the mortgage, which is already monthly. Okay, property tax. We have to take the annual property tax, which is $9,400, and divide that by 12. And that's going to give us $783.33 per month. And then we have the insurance, which was $876. We need to divide that by 12. And that's $73. So altogether, our monthly housing cost would be the $1,233 plus the $783.33 plus the $73. $2,089.33. Now I want to calculate the front end ratio. So I'm going to take my monthly housing expenses, which is the $2,089.33. I'm just going to put $2,089.33. And then I'm going to divide it by my monthly gross income of $11,292.58. And when I divide that, I get 18501, and as a percent, that's 18.5%. And we want to look at this as a percent. For a bank to approve you, your front end ratio must be less than 28% or less. So let me do that. So that means your total housing expenses need to be less than 1/3 of your monthly gross income. They want that to be 28% or less. If your mortgage and property tax and insurance are more than 28% of your income, most likely you will not get approved. Okay? They're at 18.5%, which is less than 28%. So the question is, will the bank lend them money to purchase the house? Sure, probably, if that was the only thing it was based off of. You know, assuming everything else is good, the credit and everything. Because they're good 10% below what the threshold is. And back end ratio, and your back end ratio is also known as your debt to income ratio. So your front end ratio is your housing expenses. Your back end ratio is all of your debt. Now this is not monthly utility bills and stuff. This is debt, credit cards, loans, things like that. So your back end ratio is equal to your total monthly debt divided by your gross monthly income. Okay. And they want your back end ratio to be 36%. Well, actually less than 36%. So if you're right at 36%, I don't know, you might be really iffy. Okay. Again, we're going to use monthly amounts for property taxes. We need monthly. Homeowners insurance, we need monthly. With credit cards, you know how you have a monthly minimum payment of like $20 or $30 or whatever? They don't want that. They want the total balance on a credit card, because even though you have a minimum monthly payment, your monthly debt is the total balance. So with this credit card here, we have to use the whole thing. Okay? So first things first, they have an adjusted gross income of 166,000. So we're going to take that 166,988 and we're going to divide it by 12, and we're going to get another must be nice situation. $13,915.67 a month. Monthly debt. We have monthly mortgage payment. We're going to have property taxes. We need to divide that by 12. We have a homeowner's insurance. Let's write insurance. Of 1,007. We have to divide that by 12. So these are the house costs. Then you have a car payment. Now with a car payment or other like fixed loans, like an actual loan, it's the monthly payment, because that's like a set thing. With a credit card, it's the full balance. And then the credit card is 5,100. So we have 9,888 divided by 12, which is 824. 1,007 divided by 12, which is 8392. And then we have the 510 and the 5,100. Add those together. And their monthly debt is $8,061.92. So the back end ratio would be 8,061.92 divided by 13,915.67. Which gives them a 57.9% debt to income ratio, which is not less than 36%. So is the bank going to give them money to purchase their house? No. Very bad. Okay, a balloon mortgage is a very high last payment. Okay. So your other payments are low, and people do this with the thought that they might refinance before the balloon payment comes due, or I don't know why people do this, but what happens is you're going along and you're paying your, like maybe your $500 a month house payment, and you get to the end and all of a sudden your last payment is $20,000 or more. Okay, one type of balloon payment is an interest-only balloon payment. Is your monthly payments are all interest only. Last payment is the principal. So the amount you actually borrowed. Right? No, bad. Not a good thing at all. Not a good thing at all. Even a bigger gamble than that adjustable rate mortgage thing. Okay, so what'll happen here is these people are going to take out a mortgage and they're going to take out an interest only. Where is it? Do you have much more money? Well, I typed this badly. Look at that. All kinds of. They're going to do an interest only loan. So they're going to do this one, interest only. Actually, we don't have time probably to do this whole thing. Okay, we're going to stop here. We'll calculate this tomorrow. Let me look up your homework.